Hi guys, it is your mortgage girl with Paven Ghag Mortgages powered by Nexa. Today I have Shelly here with ACC Mortgage. She's been with us before, but I have her again because she's super cool and has a lot of different loan programs. Shelly, welcome.
Thank you. Thanks for having me again.
Of course. So, last time Shelly was here, we talked about ITIN loans and self-employed. Today, I would like to talk more about self-employed. We're going to take it back to the basics. So, if you're a realtor or you're a client who wants to buy a home, this video is definitely for you.
Definitely. So let's talk a little bit about the doc types for self-employed borrowers and then what borrowers would be eligible for which type. So a lot of times your borrowers aren't going to qualify based on their tax returns because as we all know, we don't want to pay the IRS everything we owe. So we have a tendency to maybe write off a little bit too much. So it's kind of a catch-22, right? If you write off too much, it looks like your income is lower, but if you don't write up off enough, then you have to pay the government. So a lot of times when you're looking at qualifying a self-employed borrower, they no longer qualify based on what their tax returns say. So there's options for getting an income that's based off of their bank statements. So let's say you have a owner of I think I'm working on right now a cleaning, cleaners. So in this case, we've got bank statements. So we're looking at the bank statements to come up with a better accurate accounting of what their income looks like without writing things off. So when you're looking at bank statements, we can either look at 12 or 24 months. I usually do 12 because 12 seems to be the better, as far as the last 12 months being better than the previous months. You don't have to worry about 24. If it makes you look good, we can do 24, but usually it's 12. Not that much difference in pricing, maybe an eighth in rate. Not that big of a deal. So bank statements is one option. 1099 borrowers, let's talk about them for a little bit. So anybody that's a contract person, people that drive for maybe Uber or Lyft, these people are considered 1099. And their income may not work as well on a bank statement loan. So there's the options of going off their 1099. So every loan that we have, whether it be a bank statement loan, a loan for a 1099 borrower, or the P&L, there's some kind of expense factor that we're looking at. So on a bank statement program, if your borrower has maybe a CPA, enrolled agent, or a CTEC, which are different types of accountants per se, then they can give us an expense factor. So an expense factor helps us come up with your income because obviously we can't take it all at 100%. We have to be able to deduct whatever maybe expenses the business runs. So as a default, without a CPA, we take a 50% expense ratio. So basically we take all 12 months, we add them up, we divide them by 12, and then we apply an expense factor. That's one way. That's for your bank statement files. Now, if you did a 1099 borrower, so maybe someone who drives for Uber or Lyft, maybe their income that they're showing into their bank account isn't going to be as high enough. So then you have the option of looking at someone with that's a contract borrower off their 1099. What's nice about a 1099 borrower is that you don't have to take such a high expense factor. The guideline is 10. So obviously if you had a bank statement loan and you have to take 50, or you can do them as if they're 1099 instead of doing bank statement, you can do them that way and you're only taking a 10% expense factor. So that's obviously a lot better. That's the two ways. And then obviously the P&L. So P&L is pretty standard. Your expenses, your expenses, your income minus your expenses equals your income. Anyway, income. No, wait, that's not right. Profit and loss is obviously your debts, your liabilities, your assets, and then you come up with your income from there.
Yeah, I think that's exactly well said. We talked about this. So you guys, yesterday we made a video, but then I had really bad internet connection, and so it didn't do so well in recording. But I had asked Shelly this about an expense factor. Like, what is an expense factor? Like, Shelly, do you think you can tell us like an example? Like, let's say you make $100,000, and so like you take 12 months worth of statements. So if you $100,000 divided by 12, whatever that is,
Mhm.
then mortgages, and you know what? I'm gonna Google it right now. Are we doing the math? Yes.
Yes, I'm doing a little bit of math here. So,
Me too.
basically, an expense factor is whatever the company runs as far as paying out employee wages, or it could be insurance for the company. It could be whatever, that the CPA can give us an expense factor. And that's basically derived from their, my dog's growling in the back there. I don't know if you can
That's
hear him now,
okay.
but my dog's
Let him
growling.
in. Let him in. You want to let him in?
Sorry about that, guys. She has separation anxiety.
Oh no, she must be included.
Yes. This is the little one today. Yesterday was the big dog. Today it's the little one.
Yeah.
Anyway, so an expense factor is basically a number, because you can't obviously take all the bank statements, add them up, and have no expenses. So it's going to be whatever, if it's insurance, if it's rent on the property, whatever it is, gives us an expense factor, and then that's how we help calculate the income. So it's kind of hard to say based off of $100,000 what it would be, because it would be more based on case by case on the borrower, not just like an income of 100,000.
Got it. Now tell me a little bit about credit score. Is there like a minimum?
Yeah, for us, there is a minimum. We require at least a 620 to do a bank statement program. The higher credit score, the higher LTV you can go. And LTV means loan to value. So your purchase price is usually about the same as your appraised value. So, let's say that's $500,000. And then depending on your credit score, your LTV can go up, which is your loan amount. So based on a $500,000 purchase price times, let's say 80%, you're looking at a $400,000 loan amount. That's how you calculate the loan amount, based off the purchase price, for, people that aren't really familiar with that. So you're going to get that as your $400,000 as your loan amount, and you're based on your score. So your score can go higher. Your score is higher, maybe you can get an LTV of 90. But the lower your score, the lower the LTV. So 620 is probably going to be around about 75% range.
Got it. So that means they have to put down 25%.
Correct.
Okay,
So if
but
you
they
had
get in the home.
yes, and if you had a higher credit score, you can put down less. So, what we normally see is like between 80 and 90 as a LTV for, purchase right now.
Mm-hmm. What about those who only have 1 or 2 scores, or they have credit less than a year?
Okay, so we do offer a program that has a no score. So if you have a score, it has to be like 620 or higher. But if you don't have a score, we do offer a program for someone like that, which is a 75% LTV based off of a no score. Now, we all got to be a little bit realistic, right? If you don't have a score, that means you don't really have a whole lot of credit, or you have, you either maybe have 1 or 2 lines and it didn't give us a score, or you really have legit nothing. So a no score per se. It's going to be a little bit higher in rate, but then, you get in your home, you start building up your credit, and then you can always refi out of it once you have credit scores. So if you have 3, that's awesome, because then when we're looking at a borrower with 3 scores, normally we're not looking at, you have to have certain trade lines. Once you get away from your credit report rating 3, so let's say you only had 2 instead of 3, you have to have a trade line requirement. So three scores get you away from that. But if you only have 2, then you're going to be looking for maybe 3 trade lines for 12 months, or 2 trade lines for, I think it's 24 months. So, the higher your credit score, the more credit you have, the better. That's the name of the game, really, in the non-QM world.
Yeah. And for those who may not know, what is non-QM?
Non-QM means non-qualified mortgage. So if you're familiar with loans and people will say Fannie and Freddie, or FHA and VA, those are loans that you standardly qualify based off your tax returns, your income and whatnot, that you report to the IRS. Non-QM are other ways of doing loans based off of other options like bank statements or P&L or 1099. And so that's the difference between non-qualified and non-qualified mortgage and a qualified mortgage.
Awesome. So we've talked about bank statements, profit and loss. We've talked about 1099. So there's pretty much options for all self-employed clients. Even
There
if they
really
don't
is.
have three, credit lines, they have two or one or none.
Hmm. Hmm.
So what do you say to buyers that are like, well, I'm going to pay for everything in cash? Like, what are some benefits of getting a mortgage?
Well, I mean, obviously the biggest one is a write-off right there, and you never know right now with the world we're in. You always need a little bit of a nest egg for, things you're not expecting. So if you were to take your $500,000 and pay cash for a property, that it doesn't free up any of your money. And obviously, especially if you're buying, you're, doing a purchase, you're going to need money for furnishing your new property and expenses on getting new things or even doing some work on the property. So obviously the write-off is the biggest, but you don't want to throw all your money into your property because with values the way they are, they're going up and they're going down. So I think it's always better to get a loan. Now if you didn't want to do that, let's say you needed to hurry up and had to just do it right away, you could do cash and then you could come to a lender and then do what's called a delayed financing. And that's like, so if you bought a property for cash and you're like, okay, we got in, it was like a non-contingent offer and, they wanted cash and that's what they wanted. So you could pay cash and then you could do a refinance and you could get some of your money out. So that's always an option as well.
Perfect. Well, that's something we will definitely talk about next time we meet, Shelly.
Sounds
Thank
good.
you so much for coming on today and enlightening us about different self-employed options for our clients. I hope this helps clear up some of the questions, and I look forward to having you again.
Thank you so much for having me. And then if I just could say to your people that are watching this, your borrowers, she's great. She's one of the better loan officers I've worked with. And, the thing about her is if she doesn't know the answer, she finds the answer for you. And that's where I come in. And with us both together, you're definitely going to get a loan.
Yes, you're going to get a home. All
Definitely.
right. Thanks
Thank
for
you. Have a great
watching.
day. Bye.